The S&P 500 rebounded past the 5,000 yesterday. This time, a mixed set of manufacturing data and a drop in US retail sales, which fell the most in almost a year, were brought forward as soothing factors regarding the dovish Federal Reserve expectations. But if retail sales had remained strong, investors would have been as happy to see the US economy land soft. We are coming to a point where the economic data becomes meaningless. Whatever the data prints, the US stock markets find a positive narrative to keep the rally going. It's, of course, blind optimism. Investors are blinded by the brilliance of the rate cuts at the tunnel's end. Today, the US will reveal the latest producer price update. The producer price inflation is expected to have slowed in January. And if it didn't, it doesn't matter. This week only, we learned that 2 of the G7 economies entered recession, Japan and the UK. Japan lost its spot of the world's 3rd biggest economy to Germany, while Germany is in the process of losing its status as the European growth engine. GDP growth per head in the UK hints that the recession started 2 years ago. Growth in the euro area remains anemic, on the other hand, as the eurozone economies struggle with rising interest rates. But when you look at the stock markets, the Stoxx 50 index traded at an ATH even though the 4th quarter earnings miss in the region haven't been this bad for at least 4 years, according to Bloomberg. Meanwhile, the Japanese Nikkei index is closing in on a record high as well. The index is now at a spitting distance from the highest levels since the 1990s despite entering a recession in the second half of last year. Negative rates and the ultra-cheap yen keep stock prices running up a mountain. But the global stock markets are not breathing on their own at this altitude. If the central banks pull out the oxygen support, parts of the market should come down tumbling.